Good morning and welcome to MarketCast 21. We're 21 today. It's cue for a song, but I won't fall into that trap. And we've been a minute or two late in the past, haven't we? But we've never been a day late. So this MarketCast has to start with two apologies. Number one, we originally wanted to do this yesterday morning and we're doing it today instead. And number two, the most outrageous shirt of the MarketCast series so far. The reason we weren't on yesterday morning is because nowadays I do a little radio breakfast show, and this is an unmitigated and unashamed plug for it on Radio Wimborne, a great community radio station down on the south coast. So look that one out on a Wednesday and a Friday morning. But the shirt, it's spring. This is celebration. We're on the south coast. We're live in the AF Oliver offices here in Bournemouth, and we wanted a shirt that was going to reflect the changing weather and the changing conditions. Unfortunately, not too many changing conditions as far as the market is concerned. And as we slide down the head of the Diplodocus, who I am from now on, because there's a controversy raging. Is it a Diplodocus? Is it a Diplodocus? I'm going to call him Diplo, and that takes that away. And as that controversy rages, and we'll come to where we are in terms of the shape of Diplo in a moment or two, I was asked yesterday to sum the market up in 3 words. Do you remember I used to do this on the MarketCast? I used to give you 3 words to sum the market up, and somebody said, can you give us just the 3 words? That's really tricky, isn't it? Well, here are my 3 words, taken on all the data that I've received over the last 4 weeks since we last spoke. Hesitant, but hopeful and impatient. It may well seem to you that they are a contradiction in terms. We've got an election coming up. I spoke a lot about the election on the last MarketCast, and we talked about the effect that that's going to have on volumes. I still believe, I'm convinced it will have a negative effect on values. Other factors will feed into how the values move, but it will affect volumes. People are hesitant. They are waiting. They believe that a change in government may well see a change in policy, may well see a change in taxation, stamp duty, all the other things that will have an impact on their purchase. So there's a hesitancy. But they are hopeful. There's no question. We've seen a market that has been compressed down by over 20% in terms of the numbers of transactions. And that means this need is building up. There's like a pressure cooker building up, and people are generally hopeful that things will be resolved soon. They're hopeful about interest rates, and so that gives them that cause to be in the market and to be interested and be available. And the impatience, well, it's almost like a sort of a kismus really in the market right now, where people are feigning this, we're going to hang on and we're going to wait and see, but really there's a driving need for them to move. And this presents a huge opportunity for the industry. But before we get into discussing that market in just those 3 words, let's have a quick run through where we are. Interest rates. We said, didn't we, in the last MarketCast, which was just before the MPC meeting, most unlikely that there would be any change, certainly no increase, but it was most unlikely that we'd see a cut last time, and we were right. I think in June, there's a 50-50 chance. We had 2 more members of the MPC that came over to the Dove side at the last meeting, and I think that there is every chance that we might see a small, maybe 25 basis points cut at the June MPC meeting. 50-50, I think that's about it. Real wage inflation has climbed a tiny bit. The numbers, I'm sure you're aware, have come out this week, and we've seen real wage inflation climb. Actual wage inflation stayed bang on where it was, but because we've seen a fall in general inflation, it meant that we've seen a slight climb in real inflation. So even though the prices haven't moved back, as wage inflation and real inflation has increased, effectively that has reduced the comparative cost of properties. And we don't want to get into all of this balancing at this early stage in MarketCast. We'll talk about the impact of that further into the deck. Now, the RICS survey came out last week as well. They are firmly sold into the Diplodocus market, and we've seen the up, and now we're seeing the level, and now we're seeing the slight slide. There is nothing in the RICS survey that came out this week that dissuades me from that view that we're at the top of Diplo's head. The consumer confidence numbers improved a little bit in April. I'll take you through those in detail. Improved a little bit in April. We're still firmly in negative territory, but people believe their finances are getting better, and that's really important. It's going to be a tricky summer. There is no question about that. We are on Diplo's neck. We are on Diplo's neck right now, and it will be very interesting to see. Rightmove comes out next week. The May Rightmove numbers come out next week, and that will be a really good indication of how people who are taking their homes to market feel the market's moving. Be a great indication of seller sentiment, and probably no more than that. Now, you will excuse me starting this deck off with a slide that I actually showed you with great joy and gusto for last MarketCast 20. It was this one, wasn't it? This is Diplo, and I tried to find a way to describe, because we've had U-shaped recessions and V-shaped recessions and bell-shaped booms, and I tried to find a way to actually explain the complicated shape of the market ahead for 2024, and that was my example. And I put this up, didn't I? This was you'll know, certainly regular MarketCast viewers will know that as a benchmark to try and indicate where the general market moves, given that I think the whole concept of having an average price for a property in the UK is a complete nonsense anyway, but at least it gives you a really good indication of how the market's generally moving. And this is where we were, wasn't it? At the last MarketCast, with these dark blue blocks on this chart showing you the actual numbers, and then the light blue ones, the forecast. And then with great pride and not a little joy, I introduced Diplo into that forecast and showed you why I called it this dinosaur market, because this was my view as I was seeing the market gently float down into summer, and with all that hesitancy as we approach the election, which is almost certainly going to be in autumn, and we've been saying that, by the way, since last December, all this nonsense about it might be June. It was never going to be June. And so we've got this market on its... Now, the nationwide numbers came out about 2 weeks after I did the last MarketCast. So I can fill this block in here now, that block number 4. There it is, look. I was 0.1% out with my April forecast, but there is little question that we are starting to take our journey down Diplo's neck. And I believe that the data that I'm going to show you through the rest of this deck proves that we are on that sort of trajectory. And it'll be really interesting when at the end of May we see the nationwide numbers. And as you know, Nationwide published their numbers literally on the last day of the month. It'll be very interesting to see where we are with May and if that proves the point. And if it doesn't, I probably won't show you this slide in the next MarketCast. Don't tell anyone I said that. The diving board, you're probably asking yourself, dinosaurs and diving boards. This is an essential part of forward planning in this UK market. I sort of nodded to this a moment or two ago when I said the average price is a nonsense. Try and walk in a sales meeting in Durham and then walk in a sales meeting in Bristol and talk to these two completely different markets about an average price, and they will laugh at you for all the significance that it has on what they're doing, because local markets vary so enormously. But one way we can actually feed that into our overall planning is looking at the way that the UK market moves. And I've had a theory that I have expounded down the years, and in all the years that I've been working in property, that's 40 plus, it's never been any different. I have this theory. I call it my diving board theory. You can see the prop that I prepared ready for this. So this is called real preparation, isn't it? It's a diving board theory. Here it is. Here's my diving board. And basically, at this end of my diving board here is Scotland. And here we come down through the northeast and northwest. And here we come into the Midlands. And here we come down here for south and southeast. And the way the market moves is very much like that. So when things are really up, they're up much higher in the south. And then as you work your way north, then that rise is more conservative, but equally when they come down, the same applies. And you get that difference between the two markets. Now you might think that's just my crackpot theory, but what I did to try and give you a little bit of evidence to sit behind that concept, I had a quick look at the Zoopla. These are the Zoopla city indexes. They're good. Now we all know that the Zoopla algorithm is probably one of the better ones insofar as it mixes sold prices and it mixes mortgage approval levels and it mixes asking prices. A really good feel of how the market's moving. And this is one here from March 2022. And you can see here, now the reason I picked March 2022 is because that was the absolute peak of that last market boom, wasn't it? The first interest rate rises arrived in December 2021, if you remember. That's when they started kicking all the interest rates up and killed the market off as it was charging forward. We came over the top of that market in spring of 2022. So I deliberately picked it. This was the height of that market boom. And you can see up here, here's Scotland, 6% inflation. And down here, look, here's Southwest at 10%. Here's, I'm leaving London out of this, by the way, because that's like a different world, really. We'll put London off to one side. Here's Southeast at 8.5, East of England at 8.5, West Mids at 8, East Mid. So there are the numbers, the inflation numbers. This was this March, 2 years later, and you can see where we are here. Scotland, still in positive inflation, just under 2%. Here's Southwest minus 1.4, Southeast minus 1.6. So a really simple calculation. I took the percentage change over the 2 years from one to the other. Have a look at that. There you go. Scotland, Northeast, Northwest, Yorkshire and Humber, Wales, West Mids, East Mids, Southwest, Southeast and East of England. Are you getting my diving board? And it's not just the last 2 years. It doesn't matter how far you go back. Take 2 periods and the same apply. And those canny, careful Scots keep the market anchored. And then as we come further south and prices are much higher and people move much more frequently and are prepared to take much greater risks with their house and their property investments, this is the effect that it has. And what does that mean to us? And what's the point of me telling you that? Well, what it means is, as we look forward and we forecast, now, if you take 2024 as an example, I'm suggesting that we'll see the average price as we end the year around about flat. But of course, that doesn't mean that it's going to be flat in Scotland and flat in the east of England. What it means is that generally it's going to be flat, but along that line, there is going to be a whole range of scales. And I am thinking that in the south and the southeast, that we will actually see quite a significant uptick as we get towards the end of the year. And I'm thinking that Scotland will stay and the north will stay much more steady and roughly where it is now. But the further you go south, the bigger the change that we are going to see in the current price level and where we're going to be at the end of the year. That really matters if you are considering land investment across the UK and if you're looking to forecast in terms of the prices that are going to be received prices achieved, towards the end of the year. It has a huge effect because those markets behave so differently. The diving board theory, I commend it to you. Let's get into the market more generally. I always like to just take a quick look at see how the media are seeing the market and their perception. I love this here. There's 2 ways of saying the same thing. Look, this is a Guardian story. I just picked this story at random. This is not a pot shot at Savills. The fact that they've now had to change their forecast for 2024 3 times as against our, none, that's it. And so here we go. So Savills done a little bit of a U-turn, but here's the Guardian saying that they now believe that UK house prices are going to rise in 2024. All right, then how did the Daily Mail interpret that same press release and same story? Well, it's a bit like that, really. Poof, house prices are going to go up 61.5 grand on average over the next 5 years. It's the same story. It's the Savills story taken from the same press release and the same data, and there you go, two lovely interpretations of the same thing. But the important point I'm making here is this is what the consumer is seeing, and this will feed into confidence, and it will have a direct effect on sentiment, all adding into that. Remember we talked about impatient? It's all going to add into that. If you have a look at this, this is GB News website here, that the industry, there are a few people in the industry have really got about this. So here we go. 10 parts of the UK where house prices could rise by up to £94,000. I love that. There was an old ad once, wasn't there? They talked about a tyre that it has up to 100 times more grip. I didn't say what it had more grip than. It could have been an old banana skin, but it had 100 times more grip. The up to, I just love that, up to 94. And here's the expressway in here. I love this. Property expert shares biggest barrier preventing house price boom. I did read the article, quite honestly. It's all stuff you already know. From memory, I think his barrier that was a price to earnings ratio. I think that's what it was. Unimportant, really. What is important, because we know in today's consumption of media and media stories that 90% of the people flicking over that article will only see the headline, and in the headline, house price boom. This is the important bit. As far as the trade press are concerned, well, the property industry eye last week, or this week, sorry, are focusing on these nudge ups in mortgage rates. I'm sure you all heard the news this morning, and I'm sure you heard the good news about yesterday's inflation data in the United States. Seems crazy, doesn't it? In this connected global world that we're living in now, we're talking about the UK property market and how it gets affected by inflation in the US. Well, of course, the thing is that inflation is coming under control in the US, or certainly it looks that way. And if that happens, it means there's less pressure on US interest rates. And if there's less pressure on US interest rates, there's less pressure on UK interest rates. And that means there's less pressure on mortgage rates. That means the market gets better. There you go. A butterfly flaps its wings in Ashby de la Zouch and a bridge collapses. Or something like that. You know what I mean. This is an interesting one. This was in Estate Agent today. I think this was yesterday or the day before. UK house builders back in the market for land as outlook brightens. I've tried to pick a representative sample of both the consumer and the trade press across the piece, and I feel that the story the media is delivering is generally a positive one. I'm just going to show you one page out of Property Mark, apart from, of course, my beautiful chart where I have to convert their data into my beautiful chart that they don't do anymore. But this is quite an interesting one. So these are their March numbers. This is brand new. This only came out this week. And you can see that the number of market appraisals, this is from the Property Mark members. So these are the independent estate agents who are members of the Property Mark consortium group, whatever they call it. And you can see here, 7% reduction in market appraisals, slight decrease in the number of new properties coming to market. Interesting, in March I would have expected that to be a little bit higher. And here we go in March, increase in the number of potential buyers registered. You can almost feel it's the top of Diplo's head, isn't it? All of this suggests the same thing to me. Inflation is the big one, and of course, next week we've got the new numbers. It's a shame, really, that it's just, if only they could have brought that publication forward to chime with the MarketCast broadcast dates. But right now we sit there, no need for me to talk you through this slide, you saw it last time around, but the one slide that actually has changed is the wage inflation chart. And as you can see here, what we actually saw was that both real and regular pay and pay with bonuses stayed static for the March numbers. But of course, the real inflation, which is wage growth minus general inflation, crept up. So that crept up from 1.9% up to 2%. People are a little bit wealthier in net terms in March, and that's important, feeds into confidence. Here's the worry, of course. We all thought that this, and when I say we all, I'm including the Bank of England in that, by the way. I don't just mean me and the production team here. I'm talking about the Bank of England, although I'm not sure that they know much more about it than we do. I'm just saying that. But you can see that we all thought this was the trajectory really on mortgage rates. And then, of course, we had that sticky inflation. Inflation didn't come down as quickly as everybody hoped. We had then the US putting their rates up a little bit, and we got this kink in here. And now we've got a little nudging up by the institutions during this week, and that gives everybody a little bit of nervousness and pause for thought. Hopefully yesterday's news will improve this picture. But you know these charts, and you can see the general shape of where average mortgage rates are going. So what does all this mean in terms of consumer confidence? Well, it means this, and as you can see here, the red line, as you know, is the overall index. It's how consumers in the UK are feeling things are going to be over the next 12 months. Are they going to be better? Are they going to be worse? Here's neutral. Here's neutral. So the balance of people thinking things are going to get worse is higher than the people thinking things are going to get better. But look where it's come from. December 2022, and you'll remember, of course, obviously the September number was the all-time low, the Trust Kwarteng budget, mini budget, sorry. And here we go. This is where we are. So that trajectory is still going. We've got the odd occasional little dip here and there, but we have got a general improvement, and there's no question that that is feeding through. But you will all be feeling, I'm quite sure, in reservations per live site per week, you will all be feeling that there has been a little bit of a pause after quite a strong start in spring, in February, March time. There's just, you can sense that somebody's tapping the brakes, that hesitancy. The blue line here, UK economy, how's that going to fare? And you can see again from record lows back here, you can see where we are. And so everybody's still concerned about it, still well into negative, but the improvement is tangible, and that has a dramatic effect on the housing market over the longer term. And green, you can see here, is the next 12 months a good time or a bad time to make a major purchase, so a kitchen or a car, or even indeed a house. And that too, still in negative, but significant improvement. This is the one up here, look. So this is the one, this is people's own personal finances. Are you going to be better off over the next 12 months, or are you going to be poorer? And that actually crept into positive growth in February, and against all the odds, despite that little tweaking up of interest rates, it's actually stayed there, and it stays there now. Everything suggests that we are going to see this market continue just the way it is right now. It's this flat market, this hesitancy. Quick run through the key dates then. Next week, inflation numbers. Tune in for those because they're going to be enormously important to us. And of course, that will have a big effect when the MPC meets. So that's not until June 20. There is a huge amount that could happen in between now and June the 20th. Making that call is insanely difficult. I've got it 50-50. So I know that sounds like I'm sitting on the fence. Well, I suppose I am really. General election, that slide I've not changed since I did this, put this deck together back in December of last year. I still believe that the general election will be in October, November, and it will certainly fit with my Diplo theory for the market as it goes through. So quick look, really quick look then at the key data. My beautiful chart, a bit like my beautiful laundrette, this is my beautiful chart, the one that Property Mark used to produce, and now I produce that using their data. And you can see where, there we go, that was that March 2022, remember that? Spring of 2022, and down we came. So the blue, obviously, deals being done at better than asking price. The orange, deals done at asking price. And the spreading grey, it's an age thing, expanding as the market deteriorated right up to the end of 2023 and then started to improve. You all felt it. I know you did. We all felt it from December into January. Much better, January, February, but here we go. Here's Diplo's head going on right there. That's where we are. If you actually take all the bars and all the colours away, those are the percentage deals done at asking price or above, and it's all there writ large, isn't it? Mortgage approvals continue to languish. The March numbers were really disappointing. The March mortgage approvals for house purchase were 60,497. They went up from the February numbers by about 300. So in other words, no movement at all. It's that flat volume, isn't it, that's going on that I was referring to earlier on. You think normally this time of the year we're in 63, 64, 65,000. The right move index now is old hat, isn't it? A quick run through the indices, literally a few seconds. This was April. We've got the May numbers coming out next week. 1.1% asking price increase in April. That's bang on the 10-year average. Halifax came out. That came out this week as well. And you can see there flat, all the way through. Here's the nationwide numbers that came out at the end of April. Well, I showed you those right at the start of the deck in my chart. The monthly change was just a little bit down, minus 0.4, and so that takes us to 0.6 on an annual basis. And I'm seeing that that is going to stay, that monthly change, in negative, and we'll see if I'm right when I next do this market cast. Might not mention it if I'm wrong. Here's Diplo's head going on here. The 3-month on 3-month nationwide numbers are a really good way to get that trend, and I can just see that running out through the year with that slow slide, but I absolutely believe that we will see at the tail end of the year big opportunity, particularly, remember the diving board, particularly in the southern part of England. I'm not going to spend an age on this chart. It was in this month's nationwide release when they produced their numbers at the end of April. They asked people, they commissioned a survey with a company called Censuswide, which they did at the end of March. A good survey, and they asked people that the main reasons why they were delaying buying their first home. I won't bore you with these. It's all money related. Prices too high, mortgage costs higher, can't borrow enough, can't get the deposit. It's all money, that whole lot. Down here though, this was much more interesting. So that's what you'd expect, isn't it? Much more interesting in here. What are you doing if you can't afford to buy? Less expensive area, smaller property that a doer-upper needs a bit of work, fewer bedrooms, or a flat, not a house. Now that really does matter, and hopefully for all the developer watchers of MarketCast, you'll take a closer look at that and learn some of the lessons in here. Zoopla, House Price Index, there's their headline in the middle here. 64% of all the property for sale in the UK, according to Zoopla right now, 64% of all the property for sale in the UK is in an area, in a market that's in negative growth for the year. That's a very interesting statistic, as is this one here, where they show that mortgage repayments are 61% higher than they were in March 2021. That gives you a really good idea of what put the brakes on this market. But they're excellent little barometer of how the market's moving. Buyer demand, as against this time last year, up 4%. Number of sales agreed, up 12% on this time last year. Flow of new supply, slowing down a little bit now, but still up 14%. And the stock then is up 20% on this time last year. Still lower than its normal average. I won't dwell on the RICS. Suffice it to say that you can see on the Canary slide, so the newly agreed sales is pretty much flat through the UK. New vendor instructions are still very much in positive. That's what we'd expect spring market. But here's the thing. So now, in terms of where the surveyors believe prices are going to go, the 3-month indicator, the little mauve one there, in negative. So the balance of agents believe down, not up. But the 12-month there still very strongly positive. The surveyors believe that over the 12 months, that they will see prices go up, not down. And in terms of volumes, the number of homes just moved into negative now on the 3 months. They're diplodocusing, that's what they're doing. They realise it. Here's the 3 months, and here's the dinosaur's tail, because over the 12 months, even though that has come down a little bit from where it was last month, it's still very much in positive. And I agree with them. I agree with them too. So, values and volumes then for this year. Well, the matrix, that's where we were a year ago. This is where we are now. And the key elements of this now is this one here. The employment market is cooling. There's no question about that. And although we've still got wage inflation running at around 6%, that has now stopped. So the level of increase has now stopped. This month it was exactly the same as it was last month, and I feel now that's going to start to decline. I think that right now employment, which was a big positive before, is now moved into negative. Consumer confidence still sits there right in the middle. This is the picture that we've got. Great opportunity for the developers here to use financial products, creative IFAs, PX and discounts to really give you the advantage over the second-hand market. I won't dwell on Diplo because I already did that at the start of this deck, but you can see where I think prices are going to run over the next 12 months. So in summary then, as we run up to the end of this ridiculously short 30 minutes, I'm thinking of doing one in the summer when you're all on holiday, that we're going to run for 3 hours, or possibly not. So my three words, I don't know about kill you and kill me, but my 3 words: hesitant, hopeful, impatient. That is, for my summation of where the market is, that's where we're looking. I believe we're looking over the top of Diplo's head right now, and I think we've got a gentle cruise down Diplo's neck as we run down towards the election. It'll just feather down, go along, and then we'll see the tail at the back end of the year. Big difference in the way that prices are going to move north and south. Think diving board. Volumes are going to come under pressure again back in the summer months. I think you're probably all feeling that right now. And certainly prior to the election, there will be some sitting of hands. But don't forget, there's impatience out there. So if you can actually give prospects a little bit of certainty that takes them beyond that and into next year, I think you will benefit as a result. I think we've got a 50-50 chance of a rate cut next time round. If you want to get volume away before the election, you're going to have to be a bit aggressive commercially on deals and prices, no question about that. Prices across the year, I think, end up flat. Unlike Savills, I'm not changing my mind on that from last December. And volumes, I think, will be above 1 million. I don't think they'll reach 1.1. So although we'll be sort of 7.5% higher than we were last year on volumes, we're still 10-12% down on those 5 solid years from 2014 to 2019. The next MarketCast will be on Thursday, the 20th of June. We won't get you all to book for the day and then change the day just before the event, and I apologise for that. I hope you've enjoyed this crazy 30-minute charge through the market and this crazy shirt. Big thanks to James, to Hannah and to Joan, the production team this morning, and I'll see you in June.